Great, we'll get started. So welcome to today's webinar. Before I hand over to Chris, I just wanted to let everyone know there is a Q&A box at the bottom. So please do ask questions throughout the session. We've got a dedicated Q&A section at the end. So do ask the panel the questions that you have throughout. We've received some good questions already so far, so we'll try and cover those. And any that we don't get covered today, we will follow up on. There are a few polls as well throughout the session, so do get involved in those and vote, and it'll be good to see the outcome of those. So I think we're ready to go. Chris, over to you.
Thank you, Rebecca. Morning, everybody. Thank you for joining us. My name is Chris Freeth, and I'm head of the banking and finance team at Freeths. We appreciate a lot of you making time between maths and PE, whatever lessons you might have on at home for some of you. So thank you for fitting this in your busy day. We held this seminar, or webinar rather, previously in September. In some ways a lot has changed, but we're still stuck at home working and a lot still remains the same. But with the prospect of vaccine in sight, hopefully we're beginning to draw to the end. One thing's certain, that as when we had this webinar in September, there are still a lot of challenges and importantly opportunities to come over the coming months. So we thought it'd be helpful to bring together a panel of experts from Freeth to talk you through some of those challenges and opportunities. So as well as myself, we've got Fiona Powell from our HR employment team, Philip Myers, litigation, who specialises in real estate matters, Francis Dalton from our corporate team, and John Jeffries from our restructuring team. So each of those will be speaking to you briefly about their areas, and at the end there'll also be a Q&A session for an opportunity for you to put questions to the panel, which hopefully we'll be able to assist with. So without further ado, I'll hand over to Fiona, who's going to talk about HR matters.
Thanks, Chris. Hello to everyone. My name's Fiona Powell, and as Chris said, I advise on day-to-day employment issues and HR issues. And of course, the big HR issue has been furlough, and I'll be looking briefly at how businesses are continuing to utilise furlough to help manage cash flow. We're actually on our 5th extension to furlough now, which you can't quite believe we're there, but it was, we saw the extension in October. I think last time when we had this webinar, we discussed the employment position, and it was very much the case then that Rishi Sunak said he wasn't going to be extending the furlough scheme, and businesses were really preparing for redundancies at the end of October. And then, of course, we had this last-minute U-turn from the government, which then we had many client queries, because businesses had made redundancies as of the 31st of October, but then had queries from employees who'd been made redundant saying, can you bring me back? Can I be furloughed? And there were lots of issues arising, but we've seen it has been extended. It's now here till the 30th of April 2021. The general criteria is still the same. The government continued to pay the 80% of salary of employee hours, capped at 2.5. There was some query before Christmas as to whether that would be amended, but it hasn't been. But of course, this isn't, there are still costs to the employer, to the business, because you've got to pay the employer NICs, pension contributions, annual leave continues to accrue. There's also been another change since December, in that if you do make someone redundant, previously you could put them on furlough, they could serve their notice on furlough. That's not the case now, so you will have to pay someone in lieu of their notice. In terms of the general eligibility, it's still the same as before, so they have to be on the payroll as at the 30th of October. They can be furloughed on any shift pattern, so you can do flexible furlough. There has to be a written agreement, and there's not a limit on numbers. And it's for those, the government guidance says it's for those business operations where COVID-19 is affecting the operations. And of course, what does that mean exactly? And certainly when we had the 3rd lockdown and the schools closed after Christmas, there was lots of debate about, well, does this cover parents who are having to homeschool? Martin Lewis, of course, was on that crusade as well in terms of campaigning for that. The HMRC has updated its guidance, and that does confirm that employers can, they don't have to, but they can furlough employees whose health has been affected by COVID, so i.e. they're clinically extremely vulnerable, or if they have caring responsibilities such as caring for children or homeschooling, etc. So I think that extra guidance that we've seen from the government has been really helpful. Certainly our clients have been utilising it, even if they're not their COVID-19 isn't affecting their operations as such. If they are homeschooling, which a lot of employees are, then it can be utilised in that way. And it's certainly, we've seen, you know, I think the FT reported it yesterday, we've got the ONS figures out for last year, and the furlough scheme has undoubtedly helped to limit unemployment rise based on those figures. The 3-month rate up to November climbed to 5%, but the majority of that was seen in September and October, obviously, as we were building up to those redundancies, because it was thought that the furlough scheme would end. But we have obviously got high rates of those out of work, and I think the total unemployed figure at the minute is 1.72. So we've got 16%, I think, were on furlough in November, and I suppose a real concern for businesses is what's going to happen in April, because unemployment could rise again if that support is withdrawn too quickly. So that leads us to talk about, well, what do we think is going to happen? What do businesses want to happen? And we thought it would be a good point to ask you a question, which is, do you think the furlough scheme should be extended beyond April 2021? So you should have that poll question appear. And if we give you a few moments. Yes, 82%. 82% said yes, 18% said no. And I think that's very much in line with what we've seen in the media recently, and what businesses have been saying to us as well. There were reports last week, certainly the CBI and the Chamber of Commerce are calling for an extension to furlough. Sadiq Khan has called for an extension to the furlough scheme and the continued business rates holiday. I think the major concern for businesses is that they want to know sooner rather than later. What we don't want to happen is what happened in October. So businesses think furlough is coming to an end, they then make redundancies, and then there's a U-turn. And of course, there is that concern that if it suddenly stops, then redundancies will need to be made. So there's certainly that call for it. There were reports last week that the Chancellor is likely to extend, but we don't know. It's an unknown at the minute. Certainly by the 3rd of March, when the budget is here, we will hopefully know whether there's going to be an extension or if there is going to be a replacement scheme put in place. Obviously, before Christmas, when furlough was due to come to an end, there was talk about a job retention bonus and a job support scheme. They've all been put on hold, but will a similar scheme be put in place? It is something that remains to be seen. One thing that I thought I'd talk about very, very briefly as well is a change that came in from December 2020 in relation to furlough, and that's that HMRC are now publishing the names of companies who have made claims under the scheme, and that includes the amount as well. And of course, that is a deterrent. You know, it's there to stop people using the scheme when they're not supposed to be. Employers have to retain records, furlough records for 6 years, and HMRC have started completing audits on this already. Of course, they're going for those high risk areas or where there's been some sort of tip off. HMRC are really urging the British public to continue to come forward. I think the rates of reporting have increased from 3,000 back in April to 20,000 reports of furlough fraud. But of course, for businesses, for the majority of businesses who aren't entering into any sort of fraud, but they've had to grapple with, the furlough, how it works and the calculations. There is, of course, if you are concerned about any mistakes in your auditing process, undertake an audit is the best advice, but also you have got a 30-day window for self-declaration of any mistaken application. So do use that to look at whether there are any mistakes in your accounts. And of course, we have seen some companies who have done very well in the circumstances that they didn't necessarily expect, and they've been now paying it back. So I think in summary, from our perspective, we're definitely seeing clients continue to use furlough very successfully. And I think it's just hoping that we get some guidance from the government earlier than April so that businesses can plan what the next step is. So now I'll hand over to Philip.
Thank you very much, Fiona. That was very insightful. Thank you. I mean, it hardly needs to be said that the impact of COVID-19 on the economy has been immense. As a solicitor and partner at Freeth who deals with property litigation, a lot of my time is spent speaking with clients, landlords and tenants alike, advising them of their options and how they can try to get through all of this. Just painting the picture, according to the Bank of England's CHAPS data, aggregate UK debt and credit card purchases were 35% below the February 2020 average in the week to the 14th of January this year. And according to Springboard, which counts footfall across the entire retail landscape, high streets, shopping centres and retail parks, for example, in the week ending the 17th of January 2021, overall retail footfall in the UK is at 33% when compared with the same week just a year ago. It's the lowest level since the week ending since the week ending June 2020. The UK high street was under considerable pressure even before the pandemic arrived, and with it, it's brought closures across the board with no forecast of return yet to normality. And combined with a tough period post-Christmas, many long-established names such as Oasis and Warehouse and Debenhams have faltered or disappeared completely. As we now know, Arcadia's administration, that's collapsed with debts of £750 million, according to Deloitte. I read this morning, and stores are being wound down now, and many more branches expected to shutter by the end of the month. All of this turbulence has had a huge impact, not only on the retail property sector, but more widely on the commercial property sector as a whole. But what I would say is, like all economic change, this creates real opportunities as well as disadvantages for landlords and tenants alike. And while some tenants have found themselves stuck in insurmountable difficulties, others have managed to achieve re-gears of their leases. So, for example, they've agreed to remove or push back on break options. In fact, a retail client that I advised recently triggered its break option in its lease, only for the landlord then to come running back, offering a new lease on much more favourable terms than the lease that it had. So that was a great sort of win for this tenant client. I've been drafting and reviewing many forms of rent concession letters, some with rent deferrals, others granting rent-free periods, and many changing from fixed rent to turnover rents, or a combination of the two. Indeed, landlords need tenants and tenants need landlords, it hardly needs to be said. And the best thing that the parties can do, is something which I advise continually, is to speak with one another and try and reach a compromise. I usually say we'll speak on a without prejudice basis, and that simply means that whatever conversation you have, if you're making some sort of concession, that can't be relied upon by the other party if you end up in formal litigation. In other words, it allows them to speak more freely. Now, many of you will be familiar with the Coronavirus Act 2020, and I'm not going to go through that. It's quite big and it's relatively boring for non-lawyers, but it's had significant implications for landlords and tenants. It substantially affects the ability of landlords to recover possession. In summary, and I'm asked this a lot, landlords can't forfeit a commercial lease for non-payment of rent, and the date has been extended many times, and now it's 31st of March 2021, and this date may be extended further. My bet is it probably will be. And moreover, the commercial rent arrears recovery, or more colloquially and better known as sending in the bailiff to seize tenants' goods or distraint, that's been affected by changes in the legislation too. So the minimum amount of net unpaid rent that must be outstanding before CRA or sending in the bailiffs may take place is 366 days rent owing from 25th of December 2020 And this restriction is currently in place until the 31st of March. Again, I guess my best guess is that it will be extended further too. I don't intend to cover insolvency, as my colleague John, who's yet to speak, is the expert in this area. But I'll simply highlight the Corporate Insolvency and Governance Act 2020. That came into force on 26th of June last year and restricts the presentation of debt-related winding up petitions where a company can't pay its bills, including rent, due to COVID-19. Now, since most landlords don't wish to forfeit, they don't want the property back, they don't want to have the business rates liability falling back to them, I'm regularly asked about what can they do? So just to summarise, landlords can still pursue claims for debts in the county or high court. They can draw down on rent deposits and potentially pursue guarantors if there's guarantors under the lease. I've had many instructions from landlords to commence court proceedings based on rent arrears, and in most cases we've obtained court judgments quite quickly, usually in default because the tenant hasn't answered the pleadings. And these judgments can be used to assist landlords to leverage negotiations with tenants, or often simply banked effectively, and potentially to be enforced at a later date. Hopefully, if the tenant survives and goes back into the black. Now, that's really all I wish to say for now, but I'll be very happy to answer any questions in due course at the end of the talk. And I'll now hand back to Chris.
Thank you, Philip. That's very helpful. I'm going to talk to you all about what we're seeing across our banking and finance team in the current market. Speak briefly about current bank activity, what we're seeing with distressed borrowers and what the appetite is for enforcement, and perhaps a brief look at what we're hearing and what's being discussed amongst clients and contacts about what they're expecting going forward. So in terms of current bank activity, understandably it's muted. We are seeing continued lending by the clearing banks to existing clients for refinancing existing debt. But amongst the larger clearing banks, there's relatively little appetite for new customers, save for in strategic sectors, particularly care homes and some other elements of real estate, and also renewable energy, where there is a move amongst lenders to try and increase market share, which is no great surprise. There is still appetite for funding real estate assets in certain sectors, as I say, particularly sheds and beds, which is a phrase that's been bandied around for quite some time now, which is including student, which is perhaps surprising. We've recently seen bank funding for development of a student asset, which will have a gross development value when completed of around 30 million in a non-core university city. We've also seen, although not banking related, we've acted for a client on disposal to an overseas fund of purpose-built student accommodation with a value of around 65 million. So there is still activity in that sector. Sheds, industrial is very popular as well, as I've touched on as well, also renewable energy. There is a distinction to be made here to an extent between some of the large clearing banks and some of the smaller banks, the challenger banks, and also non-bank lenders. That latter category of non-bank lenders, challenger and smaller banks, are tending to be more active. That's not true across the board, but that's the general perception that we're seeing. Some of those lenders are seeing it as an opportunity to increase their market share, much as they did post the financial crisis over a decade ago now. And increasingly, I think we're going to see the market move to be more like the US, where there's a much greater, the lending market has a much greater constituents of non-bank lenders and funds, as opposed to the current climate where the clearing banks do the majority of the lending in the market. In terms of corporate lending, we are seeing some lending on acquisition finance and private equity type deals, but not huge volumes. I was discussing with Francis before this presentation, he'll be speaking later, about whether or not that bank debt is needed to properly unleash investor cash, which undoubtedly has been building up over the last year or more. But I think, and Francis would no doubt touch on this in more detail, but we're increasingly seeing that a lot of those funds are actually keen and willing to use more of their capital than would typically be the case. and there isn't quite the same demand for bank debt and to leverage those deals as it perhaps was a few years ago. One element of the banking market that's had a lot of press is in terms of the C bills and CL bills, the government support loans. They continue to be available, a bit like furlough. It tends to be a last minute decision to extend the deadline a little bit further, and the current deadline is till March 2021. In truth, we're seeing much less demand for the C bills and CL bills than was the case initially. I think most businesses that needed that support have gone out and sought it very early on, and as a result, there's very little demand for it, but there is still a trickle of those deals coming through. But I think increasingly lenders are turning their mind to how they will recover that debt as we begin to come out the other side. And in terms of enforcement and distressed borrowers, inevitably we are seeing across all sectors, some more so than others, we are seeing borrowers struggling to repay debt or service debt as it falls due. We're also seeing lenders turn their mind more towards those distressed borrowers, and that is increasingly becoming a greater part of their lending book. But very, very few lenders are seeing that as a huge concern currently. Although the numbers are going up, they feel it's generally manageable. And as a general rule, we're seeing very limited appetite to enforce. For a number of banks, again, particularly the clearing banks, and particularly those that feel there is public scrutiny on them, there is real reluctance to enforce or take any action, understandably. And really the only areas where we're beginning to see some enforcement action is the non-bank lenders, the funds who have to ultimately repay their investors, and they are beginning to look at taking enforcement action. We've got a handful of deals at the moment which are with our restructuring and insolvency colleagues, either on borrower or lender side. But interestingly, a lot of them are real estate related, where ultimately they're difficult assets and difficult to realise the cash currently. So lenders are really struggling to come up with a strategy because there's not a ready market to dispose of these assets. But it's more a case of wishing to be in control of the assets as things begin to recover. So in terms of what next, there are beginning to be discussions that some of the insolvency protections that Philip's mentioned and that John will discuss may be extended. Again, there's no clarity on that. And I think really if there was one thing we could ask for, and I guess we could all hope for that, would be greater clarity from the government on as to what's going to be happening in these sort of areas, whether it's furlough or insolvency protections. But we are beginning to hear there's a likelihood of those, or strong potential, shall we say, of those protections being extended. That's partly obviously to protect industry. You can't help but think it could also be politically motivated as well. As we come out of the pandemic, clearly the government will want to have lots of good news about the economy recovering, and a host of companies falling over as we come out the other side isn't going to help them. But obviously on the other side of the coin, there is the risk we'll begin to see a number of zombie companies continuing to limp on when everybody knows that really that they're at the end of their reasonable life expectancy. Nevertheless, there's still a high level of confidence that we speak to that while times are still uncertain, they are hopeful that the market will be strong as we come out the other side. They are seeing opportunities. They're seeing the market rebalance. They are perhaps moving away from retail, but seeing opportunities in manufacturing or care and other sectors that we've touched on already. By way of a couple of examples, we're acting for a clearing bank that's rebanking a house builder who's moving or looks to be moving across to this new bank. And that's one of the exceptions of borrowers moving from one bank to another in the current climate. We are seeing some debt for office in central London as an investment, but that's a non-bank lender rather than a clearing bank. But I think really there are reasons to be hopeful, but it's certainly a great deal of uncertainty at the moment. And one thing we probably can be certain of is the landscape of the lending market will change over the coming 6 to 12 months, with some lenders seeing it as a huge opportunity and others really retrenching and trying to hold fire. So before I pass on to Francis, I'd just like to run a brief poll. And this is actually one that we ran in September as well, but we're interested to know if those of you on this webinar believe that your banks will continue to be supportive through the current climate. So it's a simple yes, no question. just wait for those results to come in. We've got 85 participants, so we've got a decent number of to call upon. So interestingly, we've got 84% of you feel that your banks will continue to be supportive. Only 16% think that won't be the case. That's encouraging, actually, because when we did the poll in September of last year, it was 69% who thought their banks would be supportive. So I think we could take that as people feeling there's an increased level of confidence. So I'll now pass on to Francis, who's going to talk about things from a corporate perspective.
Thank you very much, Chris. Yes, hi and welcome everyone. My name is Francis Dalton. I'm a partner in the corporate team at Freeds. I've got a focus on mergers and acquisitions, and in particular a specific focus on what we call accelerated M&A, which is also known as AMA. Today I'm going to talk a bit about what accelerated M&A and what it can mean for you. So how can it turn a business threat into an opportunity? What I'm not going to cover in the next sort of 5 or 10 minutes is the M&A market more widely. However, there has been a lot of change in the market and there's a lot going on. So if you are looking at a wider M&A process, which is not accelerated or distressed, then please do get in touch and we can talk about that separately. Okay, so firstly, what is accelerated M&A? Well, it's an acquisition of a company, or very often actually the assets and business of a company, and it has the following key characteristics. Firstly, and importantly, it's done in a short time frame. There will be limited due diligence, and the buyer will focus on very specific areas of due diligence which are important to them. There will be limited recourse against the seller, so there won't be a huge suite of warranties. And the seller will want maximum certainty, both in terms of there being no conditions, but also no deferred payments. And there normally is a slightly lower purchase price than you would see on a standard M&A process, which reflects the high risk profile that the buyer is taking on. Next, I'm just going to talk a bit about what accelerated M&A is when compared to distressed M&A, because the two are often sort of spoken about together, but to us at least, they mean slightly different things. When I'm talking about AMA, I'm talking about the bit before a pre-pack, so before any insolvency or administration proceedings. And the reason that I think it's important to draw that differentiation is because it can mean higher valuations for sellers. And by way of example, we helped a client do an AMA process recently, and because they were able to get the process started in time, before they ran out of cash or before their forecasts show that they were going to run out of cash, they actually got around 3.5 more times the money that they would have got had they done it in the distress process. So it really is something worth thinking about sooner rather than later. So next, I'm just going to talk about why it's useful and where do we see it used. Well, mostly we see it to cure a cash flow shortage, why it's bringing down what could be a really good business. And it deals with one-off events, obviously COVID in this situation, but not limited to COVID, which hamper a business and the business is struggling to trade through it. So what does it mean? Firstly, it means you can pick up assets much cheaper than you might otherwise be able to do it. And we see that this is particularly important for people fulfilling a strategic objective at lower than market cost. For example, if you're looking to find a piece of software that you need to fill a hole in the business, AMA is a great way to do that because you'll be able to take that software and build it in at a lower price. Also, a small injection of capital to cure the working capital problem in the business that you're buying can yield great returns. If the business has good foundations and good processes in place, then you'll be able to, with a small injection of working capital, turn that business into a great business. There is, of course, though, higher risk for buyers because you're getting less certainty and contractual covenant strength from sellers. So what does it mean for you as a seller? Well, actually, it's a great opportunity. If you're looking at your cash flow forecast and you can see a cash out position in, let's say, 9 months, if things continue. If you start thinking about an AMA process now, you will realise a lot more value for your business than you would if you started that process in 6 or 7 months' time. So really, it's a chance for you and an opportunity for you to turn something out of nothing. In addition to the financial benefits, it of course allows the business to continue. We work with many owner-founder businesses as well, who have grown their business on their own and developed it. And the business is more than just a source of financial income. It's their pride and joy. And so knowing that that business can continue, most likely with the founder or the management in place, is a comforting factor. And finally, it saves jobs. So all those people who work in the business that's being bought, it's likely that all or certainly a decent number of them will be kept on as part of the AMA process. And then finally, I'm just going to touch on, well, okay, I'm in this position. Is there appetite from buyers? And that is, as Chris has already touched on, the answer is absolutely yes. So we are regularly receiving calls from some of our private equity clients and trade clients saying that they are now sitting on cash reserves that they want to spend to fill strategic holes. And AMA is one of the key areas that they're looking at and the key ways to do that. We are seeing less and less leverage on these acquisitions because PE firms and other funds have simply got the cash and they want to spend it, which is exactly the point that Chris was making, because we used to have a decent percentage of the consideration paid as a result of debt finance, whereas often now that's simply not the case. And finally, I leave you with a helpful thought from buyers, that buyers are saying that they are now circling assets. They're ready to buy. And so if you're in this position, see it not as a threat to your business, but as an opportunity to get something out of it. But on the subject of threats, I'm now going to hand over to my colleague John from the insolvency team, who will take it forward from here.
Thanks, Francis, and I'm sorry. I hope you're not intimidated by that introduction, but certainly I'd endorse what you were saying in my experience of AMA in the current marketplace. Morning, everybody. My name is John Jeffries. I'm a partner in the restructuring and insolvency team at Freeth, based in the Birmingham office. I'm going to give you a brief overview of some of the issues that we see facing businesses after nearly a year of restrictions from a restructuring perspective. And I'm going to touch on common themes that we're seeing, the approach of lenders in their recoveries teams to businesses in distress, the benefits of planning and early engagement, and some issues that directors should have on their agendas. So I've been practicing in restructuring insolvency for almost 25 years and have seen through a number of recessions, and each one is different. But I think it's fair to say today we face unprecedented times. I think there are some real positives coming out of this. I think we're seeing greater business resilience and an appetite to restructure. And effectively, what we've learned over previous recessions, the restructuring fundamentals remain the same for businesses today. The last recession back in 2008 was quite different. We saw the rise of what were termed zombie companies that were flat, not very productive, and were barely servicing their debt, and were really reliant upon their lenders and creditors to continue to support them. I think today's a far more positive landscape. I think businesses are generally more robust, they're better managed, they face the attrition of forced closure and changes in consumer behaviours that have come around as a result of the pandemic, and businesses that were fundamentally robust before that provide better restructuring opportunities. So we've spoken to clients, lenders and intermediaries, and there's some common themes coming across to us. And these span many different sectors in the business landscape. We're seeing limited revenues for business. We're seeing little or no reserves, and those reserves having been burnt through keeping on supporting the business during restrictions. We've seen business access all manner of government funding, including the CBILS that Chris has mentioned, the furlough schemes that Fiona's mentioned, and various other things like tax deferrals. The result, in simple terms, of a lot of these benefits have been balance sheets being weighed down with debt, Crown debt, it's not been written off, it's continuing to accrue. Landlord debt, as Philip's mentioned, there's significant arrears out there in the marketplace where businesses are unable to pay and do not face the threat of forfeiture or any other steps by a landlord being enforced. We see secured lender debt and trade debt where there's been time to pay or debt forgiveness arrangements in place, but these are all deferrals. These are not write-offs, and all of these things together on a balance sheet make a return to business as usual once we emerge from lockdown far more challenging. Combined with that, I think we do see access to liquidity as being a challenge. Whilst lenders are generally supportive, I think what you'll find is that you'll find refinance between banks difficult and rare, and we will see any prospect of an extension of facilities also quite difficult to achieve. A lot of lenders have been impacted by the return of Crown preference and how that affects their ability to recover in a distress or workout situation. And so that may mean liquidity is tighter or even unavailable. So we've spoken to recovery bankers who we regularly work with, mainly amongst the clearing banks, but also in the challenger banks. I think they forecast difficult times ahead for SMEs and mid-market companies. And unfortunately, I think they are anticipating more failures as we emerge from lockdown, as support packages come to an end, and with businesses burdened by that significant additional debt on their balance sheets, which they have to service on top of being able to fund ongoing trading. I think it's fair to say, I agree with Chris, that I think it's unlikely, particularly amongst the clearing banks, that they're going to trigger any sort of enforcement event, particularly if they're kept involved in any process to restructure going forward. But they are, as I've said, unlikely to have an appetite to sanction additional funds to bridge to better times, and will effectively push that decision-making process onto directors who will have to make those calls based on the facts and information within their control. But I don't think it's all bad news. I think there are many good businesses out there with strong management teams, make them attractive for investment or acquisition if they can successfully navigate some of the challenges that lie ahead. As Francis has said, there's significant private equity liquidity in the market at the moment, and they have funds that they need to deploy and are looking for opportunity, and that in itself can drive up prices. It's my view that it should be possible, given the strength of businesses impacted only by the pandemic, the consensual restructurings should be possible. And that is obviously always the best outcome for the business and its creditors. Where a consensual restructuring isn't possible, there are still options. And the key to success in all of these things is businesses taking early action and engagement with key stakeholders. Now, when a consensual restructuring outside of a formal process isn't possible, there are a variety of options available to a business, all of which require planning and stakeholder support. I'm not going to go into a great deal of detail of those because time doesn't allow, but we've seen the rise of CVAs, particularly in the retail space. France has already touched upon pre-packs. There are new processes that have been introduced as part of the government's packages of support, a new standalone moratorium, and a new restructuring plan. And at the moment, they are, particularly in the new processes, they are being very much utilised by larger businesses. But it's my view that as we become more familiar with those processes, it's likely to see more use within the SME and mid-market sector. We have seen signs of successful trade buyers in the marketplace. We've also seen signs of foreign investment. And I've had a particular example of this recently, which chimes with Francis's comments on AMA. I was retained by the board of directors of the Deltic Group Limited back in October of last year. Deltic was the largest operator of nightclubs in the UK, and it had been particularly badly hit by COVID. Prior to that, it was a very strong business, great, very successful and very profitable with significant cash reserves. But it was one of those businesses that had a forced closure. It fell through some of the cracks in the government support packages that were otherwise available to hospitality and leisure, and And as a result, it found itself in a position where it was rapidly burning through its cash reserves. So when I became involved in October, it had already burnt through most of those and had a limited cash runway to achieve some sort of restructuring process. And ultimately, the board decided that an AMA process was the correct avenue. The board realised almost immediately that early engagement with stakeholders, and the key stakeholders in that case being its lender and its landlords, were absolutely essential to be able to achieve the restructure that the business needed. And so those parties were kept very fully informed all the way throughout that AMA process. It was a very successful outcome. It had to be achieved using a pre-packaged process because the weight of debt on the balance sheet was just too much for any purchaser to take forward. But the result was a sale of the business through a pre-packaged insolvency. And out of 1,500 employees, 1,350 are still employed and are still in the business, and they are planning to take that forward. So it was a really great survival story. The final element I just want to touch on is some thoughts for directors. The key thing in trying to navigate the current landscape is awareness, planning, and early engagement with stakeholders and advisors. I'd be suggesting that scenario planning based on regular and accurate metrics and forecasting is actually key to ensure an ability to respond to challenges as and when they arise. Some questions that the board should be thinking about: are business plans still relevant as we emerge from restrictions? What does employee morale look like? And what are the cash flow needs of the business? It's my view that working capital management is absolutely key to avoid being caught out when the market improves and business as usual returns. And so accurate and timely forecasting, as well as careful working capital management, is absolutely essential. Thanks for listening. I'll pass back to Chris now to round up.
Thank you, John. Thank you to all our panelists. Before we move on for an opportunity for you all to ask some questions, we've got one final poll for you all. And again, this is one that we asked last time, so we're interested to compare the results. We're interested in your views as to how quickly you feel the economy will recover from this point, whether that will be a V-shaped recovery within 12 months, within 12 to 24 months, 24 to 36 months, or longer than 36 months. So as I say, we've got over 80 of you online, so a decent sample size. So I'll be interested to see the views. Just give that a last few seconds. Right, so the results are in. 11% think it'll be a V-shaped recovery within 12 months. As you can see, 19% longer than 36 months, 40% the majority feeling between 24 and 36 months, and 29% between 12 to 24 months. So compared to last time round, it's interesting actually. Again, there's slightly more positivity than before. Last time, only 3% thought there'd be a V-shaped recovery within 12 months, albeit that was going back from September. So I suppose by this coming September, 34% thought the recovery would be within 12 to 24 months, with 38% in that 24 to 36 month bracket. So very similar. 25% last time thought it'd take longer than 36 months. So there's some similarities, but actually, if anything, seems there's slightly more. Either you're a more positive group than last time, or the mood across the country has changed. Hopefully it's the latter, and it proves to be correct. So in terms of questions, we've had a few questions from you all in advance and some raised during today. I'll start with one that's come in today, which is in response to Fiona's session. Where are the furlough claims by firms published? Where can that be accessed?
It's supposed to be on the gov.uk. I have had a look and I can't actually find it, but that's where I understand them to be, and it was to be published after December. So whether they haven't yet started that process, but in terms of the person who's asked the question, I'll certainly go and have a further delve in and drop them an email, but that's where I understand them to be.
Thank you. Then a question from FHP. I won't say the names of who's asked the questions, and we are keeping that anonymous, but a question from someone at FHP. With regards to retail property, many retailers are claiming to prefer turnover rents and are likely to continue to push landlords to agree to this in the future. What are the bank's views on providing new funding to a lender looking to buy a retail property with a turnover rent, with or without a ratchet? Will banks continue to provide funding to an investor with a retail property where the tenant will only stay with a rent linked to turnover? And I suppose in a way, actually, this ties in with what Philip was saying about renegotiation of lease terms by tenants in the current climate. And also his point around retail footfall falling to 30% of what it was at January last year. I think the bricks and mortar retail market, as we all know, is going through a massive change, and nobody really knows how that's going to look as we come out, other than we can be certain it will be very different to what it was pre-COVID. Personally, the lenders I've been speaking to, I don't think there's any appetite to fund retail investment unless it's absolutely platinum type tenants. I know where lenders have retail investment on their books, they are considering how they could exit that or manage that best. And there is real concern around that. And I think lenders, like most people, particularly lenders, want certainty. And I think turnover linked rents are going to make it very difficult for the lending market, for investors in that sector. There will be exceptions. There'll be certain locations, certain tenants that are seen to be exceptions where there'll be a flood of lenders willing to provide debt. But otherwise, I think it's going to be quite challenging, certainly over the next 12 months or so. I don't know if anybody else in the panel has any views on that before we go on to the next question.
I mean, all I would say is just to reiterate that, we're seeing more and more retail clients. And in fact, you mentioned the platinum ones. I won't say which clients we had before, but some really strong retail clients that are using their clout, which brings in whatever footfall there is in the high street, to say to landlords, well, we want now to change our lease terms, irrespective of the impact that COVID's having on their business. They are using the situation to achieve better terms. But as you say, it's having a huge impact, and it's affecting the way in which lending is taking place and portfolios being managed.
Yeah, and John Smart, one of our colleagues, helpfully made the point. As we said, there are exceptions, but out of time designer outlets with good tenants are an exception, with turnover rents underpinned by ratcheted base rent. The only thing I'd say with that is we are seeing, with some of those out of town retail parks, anchor tenants demanding provisions in their lease that they can effectively bend their rent. If rent is reduced for any other tenants on the site, their rent is reduced to the same price per square foot. So if you end up with a distressed tenant and a CVA and agreeing a much reduced rent, you have to also apply that for your anchor tenant. So it is challenging. It's not unmarketable, but it is slightly challenging. So moving on to the next question, one for John. We touched on this a little bit. Will the government extend the prohibition on winding up petitions, forfeiture by landlords, and wrongful trading claims against directors again?
Yeah, that's quite tricky, that, Chris, I think, isn't it? Because crystal balls and all the rest of it. And if we thought that we'd been back in lockdown in January, in the early part of December, then we would have said no. And here we are. I think there's every prospect that might well happen. I think Phil's got the same view. And I think there's a necessary protection for businesses going forward. But I think we can't ignore the issues around, landlords themselves. That's a real challenge for them out there in the market at the minute, with rents not being paid, and they have their own debt to service in a lot of cases. I think we also have to not lose track of the fact that whilst there are prohibitions on winding up petitions in certain cases and a suspension of wrongful trading rules, there are ways to navigate around those prohibitions as well that businesses shouldn't lose sight of. The prohibition on forfeiture only relates to non-payment of rent at the minute, and I do understand that landlords are generally looking around at other ways in which they can look at enforcing their rights under leases by breach of other covenants, which historically they may not have done. I think it's also fair to say that winding up petitions is still possible, and the only restriction is if there's a COVID reason for the business not being able to pay. If the creditor can show that there was no genuine COVID reason, then they will likely be able to proceed against that against the company with those petitions. And I think finally, I'd say the wrongful trading suspension is positive. However, there are very many other avenues open to insolvency practitioners where companies have failed to look at the directors other than the wrongful trading provisions. And so I think directors must be cognizant of the fact that that is not the only the tool in the armament of the insolvency practitioner if there has been any issues relating to the failure of the company ultimately when they investigate.
Thank you, John. Francis, one for you that's come in. How do I know the right time to trigger or think about AMA?
I suppose the right time to think about it is earlier rather than later. And I think, as we talked about in the example, if you're looking at sort of a 9-month cash out position based on current trading, then now is the right time for you to be thinking about it. And it doesn't necessarily mean that you have to proceed with an AMA process. But if you think about it early and get your ducks in a row, then you'll achieve a much greater outcome if you then choose that route. But if you start that process with a 3-month cash out position, you will likely be moving into a more of a distressed position with an insolvency practitioner or an administrator in situ. So I would say 9 months cash out, that's about the right time to be thinking about it. If you're able to think about it earlier, then all the better, because the earlier you can think about it, the higher the consideration will be ultimately on the disposal.
Great, thank you for that. And another question, and I can't believe we've got this far without mentioning the B word, but are we, panel, seeing clients raising issues relating to Brexit at this time? I would say we are running other webinars, or colleagues are, specifically on Brexit, but I don't know if anyone's got anything anyone on the panel has anything they specifically want to say on that.
I'll probably take that one initially, Chris. We've done a few restructurings on the corporate side looking at Brexit, and we put in place some pretty snazzy structures to address what was going to happen on Brexit. Of course, since we've got the trade deal, a lot of that has fallen by the wayside. And so it is now more important for clients to get into the detail of exactly what they need to do if they're passing goods between countries or services. But the panic as to having a foothold in Europe is no longer there in any way, such a form as we thought it might be at the back end of last year.
That's great. Thank you, Francis. Fiona, one for you. Someone's asked about the implications if you fail to notify HMRC of any mistakes in your furlough accounts. You're on mute. Right.
Thank you, Chris. Every time I do it. So you have that 90-day window to notify. If you didn't, then the HMRC could instigate an investigation to, see whether you've broken the rules, and the implications of that, if it was found that you had, would be for you to obviously pay back. There could be a fine. So they would be the implications.
Great, thank you. And then again, Fiona, one for you. If furlough is not extended and a business has made redundancies, can you recover the cost through furlough?
No, so this goes back to the point that I mentioned earlier. Redundancy costs, no. Since December, you also can't put somebody on notice and claim through furlough either. So I suppose you could look at it now that if you are making those redundancies, that is a more costly process, because you will be paying your redundancy pay, you will be paying notice pay, unless they work their notice, which is going to be difficult in some industries. And of course, then there's accrued annual leave on top of that.
Thank you. And Philip, one for you. I'll let you read it out actually, because it's very much your niche area.
Yes, thank you. The question that we've had in, apologies, I'll get it on the screen. Question for me from Gio Hallam and Sons. Can a tenant successfully argue on an outstanding interim rent application, effective date from March 2017, so it's supposed to be asking for some time. Can a tenant now argue that due to COVID it should be lower than previously agreed on a without prejudice basis due to COVID? In other words, can there be 2 interim rents before and after March 2020? So there's what I would say is that, you know, just to give some context and background, interim rent is payable from the earliest date on which either the landlord or the tenant served a statutory notice under the Landlord and Tenant Act 1954. I won't try not to get too technical, but that date is essentially essentially 6 months from the date on which that statutory notice was served. I think the short answer is that it can be taken into account, because like the determination of rent generally on a lease renewal, it's the market rent. Now, market rent has of course changed, and with the current uncertainties, you know, tenants are reviewing their looking at their portfolios, and they're looking at this tactically. Parties have got 6 months from the termination of the old tenancy in which to apply to the court if it's a standalone interim rent application, as opposed to interim rent that's being determined as part of a full renewal. So while things are uncertain, it may be sensible to wait until the real impact of the crisis is known, and making sure that the relevant valuation evidence is collated in the meantime. Tenants, I would recommend, should consider serving Section 26 requests as soon as possible, and in fact I've done quite a few recently in order to maximise the potential reduction in the interim rent assessments. On the other hand, landlords probably want to hang fire on serving their Section 25 notices at the meantime. But just to summarise, in short, one looks at market rent, and although I haven't got any current court applications actually looking at the point now, I've got some in the pipeline. I've certainly got some RICS pact determinations where interim rent is being looked at and in different tranches because of the span of time on market rents before, during, and potentially after the COVID pandemic.
Thank you. And time just briefly for one last question, I think, raised by a bank actually. Do we believe there's enough capacity in the UK banking system to deliver the support UK businesses need during and after the pandemic? Certainly it was interesting, the poll seemed to be generally a positive view that bank support will continue to be there. I think the short answer is yes, there will be plenty of support there, but not for all sectors. And perhaps some of those sectors that need it most will find it's harder to raise debt. That may prove to be wrong, but I think that's partly because of hesitancy as to how those markets and sectors will recover, but also because of the capital adequacy rules that apply to lenders and banks in particular, and how that is going to mean they've got to be careful about how they weight their capital according to lending in certain sectors. I think that's probably all we've got time for. So thank you everybody for raising the questions today and joining. I hope you found it useful. This session will be available on video for anybody who wants to watch it subsequently or want to recommend it to any of your colleagues. And thank you, and I hope you all have a good day.